Why do traders fail? 1. Lack of proper trading education and mentorship. 2. Lack of good trading psychology. 3. Lack of simple trading system or not following rules. And the most important, 4. Lack of good money/risk management strategy. 95% of traders are failing and struggling to make money like this, while the top 5% of traders are making good amount of money like this. In this video, you will learn money management in Forex trading. Hi, welcome back, and if you are new here, welcome to Green Forex Academy, helping traders become more profitable. What is money management? Money management/risks. Money management is a crucial element of trading the financial market, especially in times of volatility. It is a defensive concept that keeps you in funds so you can trade another day to survive in trading and become profitable. Money management is part of your trading plan. Your money management strategy is part of your Forex trading plan. A profitable trader is a disciplined trader who sticks to a trading plan to execute trades. A trading plan will help you to keep your emotions in check and also prevent you from over trading. In money management, you will learn how to minimize loss and maximize profit by rule number 1, planning your risks. Rule number 2, using stop loss. Rule number 3, portfolio diversification. More highlights: position sizing, using stop loss orders, employing trailing stop, having a hedging strategy, diversifying with alternatives, becoming more profitable in trading. Rule number 1, planning your risks. Planning your risks. As a trader, you need to know beforehand how much you are willing to risk before entering a trade. It is known that aggressive traders risk between 3 to 7%, others risk between 1 to 2%. Personally, I recommend 1% for beginners in trading because less risk gives higher number of trading opportunities, while high risk gives lesser number of trading opportunities. Here is a drawdown comparison between two traders, Trader A and Trader B. Trader A is trading on 1% per trade per day, while Trader B is trading 5% per trade per day. So let's say that Trader A has $2,000 trading account and Trader B also has $2,000 trading account. Trader A decides to trade 1% per trade per day, while Trader B decides to trade 5% per trade per day. Trader A trading 1%, as you can see, she is trading lesser risk than Trader B. Trader B is trading 5%. As you can see, Trader B, if you look at his eyes, you can see that he is ready to make some good money out of the market. So now let's do the drawdown comparison between the two traders, Trader A and Trader B. I will start with Trader A, then Trader B. Here is the drawdown comparison between 1% and 5% risk. So we will start with trader A trading 1%. So let me show you how this works with an example of a drawdown comparison between two traders, trader A and trader B. Trader A risking 1% of $2,000 account will have 100 chances to trade before she can completely wipe out her trading account. Now here is a table to show you how it works. Number of trades: day 1, day 2, day 3, day 4, 5, 6, 7, 8, 9, 10. Now we have amount, balance, account balance, and then we have 1% risk per trade. So we can see clearly here that day 1, the account is $2,000 and she is trading 1% per risk. 1% risk per trade per day. So if you do 1% risk of $2,000, you will have $20. So she risks $20 day 1. She lost $20. So day 2, she's going to do $2,000. Her account balance minus her loss, she's going to have $1,980 the next day in her trading account. So the next day she is going to trade 1%. Now 1% of $1,980 is $19.80. So she risks 1% and she lost again. And this is how she lost for 10 days. Monday to Friday, 5 trading days, Monday to Friday. This is 2 weeks of trading, and she kept losing 1%, 1%, 1%, 1%, 1%. At the end of day 10, she lost $191.22. So if we want to check the calculation here, we can see that the money she lost, which is $191.22, divide by the account trading balance, which is 2,000, initial balance 2,000, multiplied by 100, you will have 9.56%. So trader A lost 9.56%, which is $191.22 of her trading account in 2 weeks of trading. So let's check to see if our calculation is correct. Now checking, this is some mathematics. If you don't know much about calculation, there's no problem. $2,000, the initial deposit, minus the last, which is $191.22. The balance will be, after losing the whole 10 trades, losing 1% on each trade, she lost $191.22. So if we minus from the initial capital, we will have $1,808.78. Now when we say $1,808.78 divide by 2,000 multiply by 100, we have 90.44%. Trader A trading account balance is $1,808.78, which is 90.44% of 2,000. Therefore, the lost 9.56% and current balance 90.44% is equal to 100%. So when you plus the lost, she lost 9.56%, and then she has the balance of $1,808.78, which is 90.44%. When you plus this together, you have 100%. So our calculation is correct. This is some mathematics to check to see if what we have done here is correct. So you can see that she just lost only $191.22, which is not even up to $200 from $2,000 account, while trading 1% per trade per day. So we will go over to trader B and see what result we're going to get from trader B trading 5%. Let's go over to trader B and see how he trades, and we can analyze and do the drawdown comparison between the two traders. So here is the drawdown comparison, and for trader B trading 5% risks per trade per day. So trader B risking 5% of $2,000 trading account will have 20 chances to trade before he can completely wipe out his trading account. Now on day one, he has his $2,000 in his account, and risking 5% risk per trade per day, which is $100. You can see he lost. The second day is going to be $2,000 minus $100. It's going to be $1,900. Now the next day, which is day two, now he needs to risk 5%. Now 5% is $95. Now he trade in loss again, and then the next day is going to be $1,900 minus $95. So day three is going to be $1,805. So like that, he keep losing for 10 days, which is Monday to Friday, 5 days, Monday to Friday, 2 weeks, 10 days of trading. He lost $802.50. Now going over this calculation, $802.50 divided by $2,000 initial deposit multiplied by 100 is equal to 40.12%. Trader B lost 40.12% of his account in 2 weeks of trading. Now checking the calculation to see if it is correct, $2,000 minus $802.50 is equal to $1,197.50. So when we divide that by 2,000 multiplied by 100 is equal to 59.88%. Trader B trading account balance is $1,197.50, which is 59.88% of his account. Now therefore the loss is equal to 40.12%, and current balance is 59.88% is equal to 100%. If we plus the loss, which is 40.12% plus 59.88% is equal to 100%. So our calculation is correct. You can see that here trader B has lost in 10 days $802.50 just in 10 days. With $2,000 account, if he trade in the next 10 days, which is in a month, he is likely to wipe out his account just trading one trade per day. So you can see the difference between trader A and trader B. Trader A trading 1% lost just only $191.22, and trader B lost $802.50. So you can see the difference, and here trader B has just 20 chances to lose his account, to wipe out his account completely, while trader A has 100 chances to trade before she can completely wipe out her trading account. So the drawdown comparison between trader A and trader B shows that trader A is a wise trader. Trader B is an aggressive trader. If you look at trader B, you will see that he is, even looking at his eyes, you will see that he is a serious guy. He wants some good money out of the market. So he wants to trade aggressively, 5%. He wants to make some money. This is the reason why some traders cannot even survive in trading, because it doesn't mean, even if you have a good strategy and you are trading high risks, you might not survive in the market. It's very difficult. The chances is very slim for someone to survive trading high risks, except if you are one of the top 5%. You are a professional, disciplined trader, and you know what you're doing, and what you're doing is working for you. Then you want to go and keep making money that way. But as a beginner, I will recommend 1%. If you are a beginner in trading, I recommend 1% per trade per day. That way you have 100 chances before you can completely wipe out your account. So be wise and don't be so aggressive when you're starting out in trading. That way you will survive in trading. Happy trading. In my next video, I'll be talking about rule number 2, using stop loss. Watch out for my next video. If you learned something from this video, please like and subscribe for more videos. Please pay it forward by sharing this video with others.